In today's video, we're going to be talking about how you can consolidate debt through a home equity line of credit and a potential 401k loan. If you think that sounds kind of crazy, I know, it sounded crazy to me as well. And these are a little bit different than other debt consolidation methods. If you have not watched our first video on debt consolidation, go back and watch that first. There's going to be a link in the description below. We'll also pin it as a comment. Watch that first and then watch this video. If you've already watched it, you've come to the right place. In today's video, we're going to cover the other ways that you can consolidate debt and also improve your credit score as well. Home equity lines of credit, or HELOCs, are kind of like a credit card in that it allows you to borrow against a limit as often as needed, giving you the flexibility to borrow against your home's equity. And this is only for homeowners, by the way. And most HELOCs have adjustable interest rates, which means that as benchmark rates go up or down, which they're going up in 2022, your HELOC's interest rate will change as well. However, typically interest rates on HELOCs are significantly lower than the average rates on credit cards, which is why it would be used for debt consolidation if needed. HELOCs have grown in popularity over the last few years. In fact, in Q4 of 2021, the volume of HELOCs grew 31% year over year, likely due to the skyrocketing home values and therefore increases in equity for homeowners. HELOCs are usually set as a 10-year loan term, requiring you to make the minimum monthly payments on your outstanding balance each month and then pay back the balance in full after 10 years. This is referred to as an interest-only loan and can help you reduce payments now, but could also lead to a large balloon payment at the end of the term. While requirements will vary by lender, according to NerdWallet, you'll typically need a debt-to-income ratio of 40% or less and a credit score of 620 or higher, and at least 15% equity in your home. The last requirement may sound a bit confusing, but essentially, if your home is valued at $500K and you have a mortgage balance of $250K in your home, then you have $250,000 in equity, or 50% equity in your home. HELOCs can be a great way to tap into your home's equity to make home improvements and consolidate debt. In fact, around 24% of homeowners who consider HELOCs want to use it to help consolidate debt. Personally, we used our HELOC to fund some home improvements and increase our home value long term. But here's a few reasons why it might not be the first go-to tool for consolidating debt. If your income is at all unstable, you may want to reconsider the HELOC. If you get behind on your monthly payments, you could get into a lot of trouble with your lender, and in the worst case, this could even lead to a foreclosure. So, yeah, this is one you really want to think about before committing to. Second of all, if you're just looking for a small amount of debt consolidation money, like 10, 20K, it's probably better just looking for a balance transfer credit card. With HELOCs, there's plenty of upfront costs from application fees, home appraisals, and other fees and charges. You want to make sure that the fees you pay are actually worth it for your situation. Also, HELOCs can take a ton of time. So if you're looking for a fast way, this probably is not it. It can take weeks or months to get through this process. Also, variable rates can leave you exposed to rising interest rates, so you need to take that into account. These types of loan agreements will disclose a lifetime cap or the highest possible interest rate that you could be charged. So make sure that you can afford that if necessary. If you want more tips like this to grow your wealth, pay off debt, and learn all the financial 101 tools that maybe we weren't all taught in high school and college, hit subscribe and follow along. And now let's talk about the 401k loan, which might be surprising to people. This allows you to borrow against your retirement savings. And while it is a relatively low interest loan option, similar to that HELOC, we recommend using this as a last resort option. But how do these 401k loans work? While rules vary by employer, 401k plans will typically allow you to borrow up to half of your retirement account balance for up to 5 years on a 5-year term. The limit is $50K. And the reason this method made the list is because these loans are cheaper than credit cards and they have no impact on your credit score. However, there are some things you absolutely need to know. First, you pay the interest back to your 401k account, kind of like to yourself. And while paying interest back to yourself doesn't sound that bad, this tends to hurt your future retirement savings because you're paying yourself back with after-tax dollars that will then be taxed again when you eventually withdraw the money in retirement. This double taxation can add up and eat away at your potential investment growth. You also will miss out on the power of compounding, which we cover in another video that we're gonna link below. Second, when you take a 401k loan, you don't pay taxes on the amount received. However, if you do not pay that loan back on time, the remaining loan balance may be considered a distribution, which means it becomes taxable income. And even worse, on top of that, if you are younger than 59 and a half, a 10% early withdrawal penalty will also be added. So while the 401k loan can be useful due to its low interest rate and having no effect on your credit score, not paying your loan back on time could bring some serious risk in retirement. And even if you do pay your loan back on time, the double taxation can still really hurt you. Because of these downside risks, we think that a 401k loan should be saved only for an emergency situation. So now that we've covered the ways that you can consolidate debt through a home equity line of credit and a potential 401k loan, let's talk about how you can improve your credit score. We'll break this section out into really two main categories, either building credit from scratch or improving your existing credit score. If you're looking to build credit from scratch, we've all been there, right? At some point, all of us started from scratch. Start by opening a checking account with a bank or some institution that also provides credit through other products. Checking accounts don't necessarily have a direct impact on your credit score, but can factor into that institution's decision on extending credit to you later on. If they see positive behavior with your bank account and you never go delinquent or negative balance, they may see you as a more reliable borrower than someone who has never even done business with them whatsoever. You can also open a secured credit card, which secures your credit limit with a deposit at that bank. The bank then uses your deposit as the collateral if you were to default on that credit card payment. If you want a credit limit of, let's say, $500 on that credit card, you would need to make a deposit of $500 at the bank. It's that simple. And then after time, eventually that bank should allow you to then convert the secured credit card into an unsecured credit card. And then when that happens, you'll have full access to the cash that they held as collateral. This allows you to start using a credit card early on and then build up your payment history, which again is 35% of your credit score. Just make sure that that bank or institution actually does report that secured credit card to your credit agency, because not all do. Also note that we're not talking about a prepaid card here. Prepaid cards are very different than a secured credit card. Prepaid cards also don't have any really impact on your credit. You can also look into getting a co-signer to co-sign a loan for you. This will allow you to get the benefit of the co-signer's credit history, assuming it's good, and therefore increase the approval odds in terms of your potential loan. As the co-signer is legally liable for any credit extended in these cases, you would typically only want to ask a close family member or friend to do this for you. A family member did this for me when I was in college and I needed a used car. I had to apply for an auto loan. That co-signer allowed me to even get approved for the loan, get a better rate, and then it helped improve my credit history going forward. The next time I wanted to, buy a car, they saw that I had done it previously. If you're looking to improve your already existing credit score, focus on growing your credit score with really good habits. You gotta start there. This starts with paying off all bills on time and in full. Don't let any balances carry over to the next statement period, which is typically monthly, and then do not pay a penny in interest. Don't pay interest. An easy step to take here is to set up automatic payments for each of your credit cards and loans that pay off the statement balance in full, so you don't ever have to log in and make that payment every single month. Use automation to your advantage and reduce the number of frictional manual steps needed to take positive actions. Let's say you have established credit and you spend too much on your credit cards and then you find it harder to pay these off in full. Stop using your credit cards for a few months and let yourself catch up. Take a breather. It's a really slippery slope into credit card debt, so don't let yourself get close to that edge. But that does not mean you should close your credit card accounts. I think this is a confusing topic here. In fact, closing accounts can be detrimental to your credit score actually, as it reduces your overall credit limit that we talked about previously, therefore increasing the percentage of debt owed of your available credit limit. Instead, keep these accounts open and just stop using them for a bit, but keep paying them. You should also know your credit limit on each credit card and spend no more than 30% of the limit at any time. If your balance goes above that 30% mark, remember, of your available credit, you'll see your credit score drop pretty significantly. This is a red flag to the credit bureaus, so avoid that threshold. Overall, your goal here in building your credit, whether from scratch or already existing, is to get that credit score above 720 or maybe even 750 and above. So you can pretty much guarantee yourself the most favorable odds and terms no matter what type of credit you apply for, whether it's a credit card, loan, mortgage, auto loan, anything. If you don't already, download one of the free credit monitoring apps that allow you to track your credit score. I check mine almost every day or maybe even weekly. And you might be surprised at how better understanding your credit score and just being more aware of it can actually lead to better financial habits in the end. All right, hope this video helped. Thanks for watching. I'm Tony from Wealthfront. Take care.